Okay, let's just ask the million-dollar question right off the bat. At age 70, does paying for term life insurance actually make financial sense for your legacy? We're going to break down the real math, the hidden rules, and what literally happens to your money over time.
Here is our roadmap for today. We've got 1. Actuarial realities at age 70. 2. Hidden policy coverage traps. 3. The true cost of premiums. 4. The self-funding alternative. And 5. Medicaid and asset protection trusts. Let's jump in.
So, starting with part 1, actuarial realities at age 70.
All right, getting term life insurance at 70 is honestly a pretty harsh collision with reality. Age is the ultimate driver of mortality risk, right? For underwriters, the probability of severe health changes goes way up after age 65. Because the 70-year-old statistically just has fewer years ahead than, say, a 30-year-old, insurers have to aggressively hike their pricing. They basically have to squeeze all those premium collections into a much shorter window to cover the high probability of actually having to pay out.
And just getting your foot in the door is a massive hurdle. While a younger person might just answer a couple of basic questions on an applicant at age 70 faces a really invasive gauntlet. We're talking physical exams, blood and urine analysis, EKGs, and a rigorous review of your whole medical history by your doctor. Any chronic condition, even just a slightly elevated BMI, can trigger massive premium markups, or honestly, just an outright rejection.
Moving on to part 2, hidden policy coverage traps.
Now, if you do happen to get approved, especially through one of those group affinity plans, you really need to watch out for something called the step-down benefit. These policies kind of lure you in with lower initial premiums, but here is the major catch. The death benefit literally shrinks just as your actual mortality risk is hitting its peak. Just look at how drastically these payouts drop. Say you buy a policy at age 70 with $50,000 in coverage. Well, at age 75, the policy mandates an automatic reduction to $25,000. And then by age 80, it plummets to just $12,500. It's crazy. You're paying premiums that stay exactly the same or even go up for a benefit that is basically vanishing into thin air. And there's another structural hazard to be aware of, the conversion deadline trap. Most term policies let you convert to a permanent policy without taking a new medical exam, but insurers almost universally cut this option off at age 70. This means if you bought a 20-year policy at age 60, your conversion option completely expires the exact second you turn 70. If you fall ill at 71, no way. You are completely barred from converting, and your permanent safety net is just gone.
All right, part 3, the true cost of premiums.
You see, traditional term life is structurally designed to expire, and the major carriers deliberately restrict older applicants. For example, Penn Mutual and Fidelity enforce very strict age 70 cutoffs for their standard term products. Now, Banner Life is a bit more accommodating, going up to age 75, and Transamerica might issue a 10-year term up to age 80. But getting the coverage is really only half the battle. Paying for it, that is a whole different story.
Because rates are tied to life expectancies, costs absolutely skyrocket as we age. Let's look at the numbers for a 70-year-old male. If you want a 20-year, $1 million policy, you are staring down over $20,000 a year in non-refundable premiums. Over 20 years, that's more than $400,000 right out of pocket. And if you survive to age 90, the policy terminates. You forfeit nearly $500,000 of your retirement wealth with absolutely zero return. And wow, here is a statistic that should really make you pause. Actuarial data reveals that over 95% of all term life insurance policies expire without ever paying out a death benefit. 95%. Term insurance is purely protection. There's no savings or investment component to it. So, for a 70-year-old facing those exorbitant premiums, it is an incredibly inefficient way to allocate your hard-earned money.
Which brings us to part 4, the self-funding alternative.
Let's actually compare those premium dollars against conservative investments. Think about a massive $5 million term policy that costs $150,000 annually. Now imagine putting that exact same amount into a conservative 8% yield instead. Sure, if you pass away in year 3, the insurance provides incredible leverage, but look at year 10. If you survive the term, your $1.5 million in premiums vanishes completely. The policy lapses and its value is zero. But if you had placed those identical funds in a compounding yield, you'd build over $2.3 million in liquid wealth. That's wealth that stays entirely under your control, is fully accessible, and passes intact to your heirs.
Now, if you're holding large cash reserves to self-fund, where you put that money absolutely matters. Bank CDs are pretty common, sure, but they're taxable, they come with strict withdrawal penalties, and fixed yields just get eaten alive by inflation. A mathematically superior option? U.S. Treasuries, specifically TIPS, or Treasury Inflation-Protected Securities. They carry an unlimited government guarantee, they are state and local tax exempt, and their principal adjusts directly with inflation, which makes sure your estate actually retains its true purchasing power.
And finally, Part 5, Medicaid and Asset Protection Trusts.
So, holding millions in liquid wealth does introduce a massive new risk at age 70. The devastating cost of long-term custodial care. The data shows that 70% of seniors will eventually need this kind of care. Medicare barely covers it, which forces a lot of folks to rely on Medicaid. But here's the trap. Medicaid is asset-tested. You basically have to spend down your liquid assets to a mere $2,000 just to qualify. And guess what? The cash value of permanent life insurance counts against you, often forcing seniors to surrender their policies and drain everything on our nursing home before they can get any public assistance.
To avoid that nightmare scenario, planners often recommend setting up a Medicaid Asset Protection Trust, or MAPT. Here's how it works. A healthy senior establishes an irrevocable MAPT and transfers their home and liquid assets into it. As long as you do this outside of Medicaid's strict 5-year look-back window, those assets are legally excluded from Medicaid's countable limits. The result? You become Medicaid eligible with zero countable assets while your life savings are preserved completely untouched, ready to pass tax-free to your heirs.
So as you plan for the decades ahead and weigh the astronomical costs of senior term life insurance against the real power of self-funding and trust protection, I want you to consider this carefully. Are you funding an insurance company's bottom line, or are you securing true, lasting wealth for your own family? Thank you for checking out this explainer, and we really hope this empowers you to take full control of your financial legacy.